Welcome to the Deep Dive. Today we're jumping straight into Confluent's Q3 2025 results. We'll give you a quick, informed view on the numbers, what's driving them, and what their outlook tells us. Okay, let's unpack this. Confluent definitely put up some strong numbers this quarter. We're seeing not just good top-line results, but some real financial discipline too. Total revenue landed at $298.5 million. That's, comfortably above the consensus, which is around $292.56 million. But the number everyone watches, profitability, non-GAAP EPS, that came in at 0.13 cents. Pretty solid beat there, topping the analyst estimate of $0.10 by 3 cents.
Yeah, that EPS beat is definitely the headline grabber. But what's really interesting, I think, is what it signals strategically. This isn't just like a one-off margin improvement. It suggests they're really making that shift, away from just burning cash for growth towards more durable consumption-based models, which is exactly what the market wants to see from these big sauce players right now.
Makes sense. So where's the revenue coming from? The core drivers seem healthy as well. Subscription revenue that hit $286 million, about 19% year-over-year growth, steady. But the real growth engine is still the cloud, right? Confluent Cloud revenue jumped 24% year-over-year, reaching $161 million.
Exactly. And that strong consumption is translating directly into efficiency gains now. We absolutely have to talk about the margins because that tells the story of operational control. Their non-GAAP operating margin reached 9.7%. That's a pretty substantial jump, 3.4 percentage points year over year. And crucially, it beat their own guidance by 270 basis points. So when the CFO talks about durable, profitable growth, well, it seems pretty spot on.
And it wasn't just operating margin. I noticed the cash flow efficiency looked much stronger, too. That says a lot.
Oh, absolutely. Adjusted free cash flow margin was up 4.5 percentage points year over year, landing at 8.2%. That's, a critical sign that they're scaling sustainably. And if you want proof of real long-term customer buy-in, well, you look at RPO, remaining performance obligations.
Right, RPO. Maybe just quickly remind listeners what that represents and why its growth is so significant right now.
Sure. RPO is basically the total value of all the contracts they've signed but haven't yet delivered or booked as revenue. Think of it as like guaranteed future revenue visibility. And in Q3, their RPO growth accelerated to 43% year over year. Now, in this kind of macro environment where companies are really scrutinizing spend, that acceleration is powerful. It tells you existing customers aren't just staying, they're doubling down, signing bigger, longer deals. That stickiness, that future revenue view, it's clearly getting stronger.
Okay, that profitability picture is pretty compelling. But strong margins don't just happen, right? What were the operational gears turning behind the scenes this quarter? Let's shift focus maybe to the growth drivers, especially around customer wins and quality.
Yeah, and the quality aspect is key. It seems driven by really mission-critical stuff. We saw a definite pickup in large customer ads. Those customers spending over $100,000 a year, the $100K plus ARR cohort, that reached 1,487. That's up 10% year over year. But the really notable thing was the sequential ad. They added 48 net new customers in that tier just in Q3. That's their best quarter for net ads there in 2 years. So momentum's picking up.
Does that scale up to the really big enterprise deals too?
It does. The $1 million plus ARR customers grew to 234. That's showing 27% year-over-year acceleration. And they're landing significant new names like a major AI analytics company, one from the Forbes 50 AI list, which brings us neatly to the core of their strategy right now, the data streaming platform, the DSP, and specifically Flink, Apache Flink.
Right. Flink seems to be where a lot of the buzz is. Since the acquisition, it feels like it's become a central piece. What are the numbers telling us about how quickly customers are adopting it?
The Flink story is really impressive, actually. It's about successful integration and now monetization. So Flink ARR, specifically for Confluent Cloud, it grew more than 70% sequentially, just in Q3.
70% sequentially?
Yeah. It's not just a pilot program anymore. This is a scaled product. It's already a low 8-figure ARR business on its own. That really validates how quickly they integrated Immerok after acquiring them. And it's not niche adoption either. Over 1,000 customers used Flink during the quarter. That shows pretty broad uptake of this stream processing capability.
So what's the bigger story they're telling with Flink? Why are they pushing this idea of the DSP with Flink inside as the sort of essential context layer for AI?
This is where Confluent tries to stand out, from just being infrastructure. AI models need that constant stream of reliable data, what they call real-time context. The CEO, Jay Krebs, he specifically talked about this contrast. The typical enterprise problem where the data you feed your AI agents is messy or unreliable or just plain old. Confluent is positioning their DSP as the thing that cleans, processes, and delivers trustworthy, continuous context before it even gets to the AI model. They're essentially selling the fix for the AI garbage in, garbage out problem. Because without that stream processing, companies are stuck trying to manually prep static data sets, which just doesn't scale for real production AI.
That's a pretty compelling narrative. But while they're pushing into AI, they still face competition in their core Kafka market, right? Especially from the big cloud providers on streaming services. How are they holding up there?
Competitively, they still look really strong. They reported win rates against the cloud service provider offerings, the CSPs, remained well above 90%. But the key thing is how they're winning. It seems to come down to specialized tech that delivers a better TCO, a better total cost of ownership for the customer.
Can you elaborate on that? What's the tech giving them that edge? You mentioned freight clusters and warp stream earlier.
Exactly. So WarpStream, which actually just hit its one-year acquisition anniversary this quarter, saw its consumption grow almost 8x in that first year. The main advantage of WarpStream and also their freight clusters offering is efficiency, pure and simple. They let Confluent offer lower latency and much higher data density. Basically, you process more data for less money compared to the native cloud options. For companies dealing with huge real-time data flows, this kind of optimized architecture can seriously lower their overall costs. And that tech advantage seems to be why their average deal size when they go head-to-head with a CSP has more than doubled in just the last 2 quarters. They're not just winning, they're winning the big, complex deals.
Okay, so that efficiency story and the Flink momentum definitely paint a clear strategic picture. Let's look ahead now. What kind of guidance did the company give for Q4 and the full year?
For Q4 2025, the guidance looks pretty disciplined. They're expecting subscription revenue between $295.5 million and $296.5 million. That focus on efficiency is still there, with non-GAAP operating margin projected around 7%, and non-GAAP net income per share estimated between $0.09 and $0.10 for the quarter.
And for the full fiscal year 2025, how does that look?
For the full year, subscription revenue guidance is between $1,113.5 million and $11,114.5 million. They're holding that non-GAAP operating margin forecast steady at around 7%. But importantly, the non-GAAP EPS guidance for the full year is notably higher at $0.39 and 40 cents per share.
Okay, let's pause there. That full year revenue guidance, around $1.11 billion, that's actually a bit below what analysts were expecting, right? Consensus was closer to $1.15 billion. Yet the RPO growth was strong, efficiency is up. So why the slightly cautious revenue outlook? Is it macro concerns or maybe just setting expectations conservatively?
I think it's probably a mix of both, leaning towards strategic prudence. It's classic management right now. By guiding the full-year EPS, that little earned 39 cents fewer and 40 cents range, above the consensus of 36 cents, they're clearly signaling that profitability is the main focus. That's the priority metric. They're choosing, durability and predictability over maybe pushing for maximum top-line growth right now. The slightly lower revenue guide likely bakes in some caution about the ongoing macro picture, making sure they can hit those profit targets even if consumption growth isn't quite as explosive. It delivers what the market seems to value most at the moment: profitable, reliable growth.
Got it. And looking ahead, what are the key drivers they're banking on to deliver on this guidance through the rest of the year?
They seem to be counting on continued strength in 3 main areas. First, just continued DSP platform adoption, especially Flink, which we've talked a lot about. Second, really leaning into that AI opportunity. They highlighted having over 100 AI native customers now, so they're building a solid base there. And third, their partner ecosystem is really starting to pay off. Partner-sourced deals now account for over 25% of their new business, looking at the last 12 months. That partner channel gives them reach without massively increasing their own sales costs, which, again, feeds back into that margin efficiency story we saw in Q3. #outro.
All right, so to quickly wrap up this deep dive, Confluent Q3 really looks like a story of strategic execution paying off. They beat on the top and bottom lines, showed significant margin expansion. That 9.7% non-GAAP operating margin is key. And the underlying engine, things like Confluent Cloud, Flink adoption, and their tech edge over competitors, seems to be driving high-value customer growth, which we see reflected in that strong RPO number.
Exactly. Which leads us to maybe a final thought for you, the listener, to chew on. And it's a big if, but increasingly likely if the whole move from just playing with AI to actually deploying it widely in production really depends on having that continuous real-time context. that living context instead of old static data. Then how much more critical does that make data streaming platforms in the entire enterprise IT setup over, say, the next year or two? It feels like a potential shift from data streaming being important for analysis to being absolutely fundamental for intelligent automated action. And that really elevates Confluent's strategic position.
Definitely something to watch as these real-time systems potentially become the default. Thanks for joining us for this deep dive.